2024 has been an interesting year for the rise of new venture capital in India. Would you say that?
I think it's a year where things are stabilizing a bit. I wouldn't say we've added too much. I think the additions happened over the last 2, 3, 4 years. So we've had an explosion in new managers who, as you rightly said, raised predominantly from India, and it's a surprising trend because Indian, investors stayed away from very long-term locked-up capital, which is what venture capital is, right? Somewhere in the middle part of the last decade, I think the appetite was beginning to get whetted, given the headlines were like, Tiger's made so much money, or SoftBank has made so much money of some of our biggest unicorns, and they don't get a slice of it at all, right? But from what I recall, AIF regulations came in 2012, which made it a little more streamlined to raise from domestic pools of capital. And what got raised between 2012 and 18, Shereen, I think between 18 and 22, there was 10x more capital coming from domestic shows, right? That's what we heard in IBCA. So what it meant is that there's a lot more appetite to take that risk. I would actually argue to the contrary that it's actually slowed down a little. I'll tell you what I mean by that. Playing blind into a capital pool that's a venture fund is less appealing than playing directly into companies. So if you saw today, Zepto, for regulatory or other reasons, is able to tap into Indian family offices for direct investing. So is ACO, right? These are the headlines in the last 2 days, right? Zepto and ACO are able to tap into large Indian family offices. And I think Indian family offices are getting savvy. If there was another article or somewhere that I read about the quality of talent that's going up in Indian family offices. So you're suddenly building Indian family offices becoming as professional as venture funds suddenly, because they're taking direct exposure, right? So we might be writing 10, 50 crore checks to start a relationship. They're writing 100 crore checks into a single investment, right? So they are becoming sort of mid-market PE/pre-IPO kind of investors, if not classic venture investors. And it's wonderful to see the spectrum of risk evolve in India. And I don't think it'll be one size fits all. I think a lot of their investing into funds like us is more experimental. They're buying pipeline to understand the market better, to be able to look at what's coming down the pipe, understand trends. They all come very attentively to our AGMs. They hear what's going on. And then they want to play the best of those companies as they're breaking out. And they're getting close to public when actually, ironically, most of the funds want to exit. And Indian investors are saying, it's our market. This is a company that can grow 10x like a Zomato. I'll buy into it now, right? And so they're getting savvy. And it's good to see this. It's good to see this because that you can't rely on SoftBank and 10 other SoftBanks to buy out all our late stage risk. It's a path to public risk, which only the Indian domestic capital should, sort of anchor. And that's happening a lot more, I think.
Well, Hemant, what's your thought on the anchor that has emerged in the Indian startup ecosystem driven by domestic capital?
I mean, look, one of the biggest beneficiary is the IPO market, right? So it used to be that majority of the capital going into public markets in India was foreign. Now it is well balanced, and actually at some point in time it was actually much higher on the domestic side. And what is really exciting for us is that while of course the valuations may be a bit inflated compared to our peers in the same category in the US or other European markets, we do think the potential for upside in India is just so much higher. The internet penetration is still fairly low. E-commerce penetration is still fairly low. Wealth tech, health tech, insurance, all these things are still very, very nascent in India, which is the reason why these multiples are much higher, sometimes 2 to 3x higher for the same category in India versus in the US. The other thing I'll add is I think India is an attractive destination because as we saw with Unicommerce, even small to mid-sized IPOs are getting a lot of attention. It is very hard for some of these companies to provide liquidity to their investors in other markets, especially US and Europe. In the US, you've got to get to about $500 million of revenue to even be noticed by the ones that build their IPO book. But I think India market in IPO is where the US market was probably in the 80s or 90s. If you just take an example, like Amazon, when they IPO'd in 96 or 97, I think they had about $15 million of revenue and they had no profit. I mean, they didn't have profit for many, many years after that. Netscape, that IPO'd in 94, 2025 was $11-12 million in profit, sorry, in revenue and zero profit. They IPO'd at that stage. And then when you allow these kind of companies to healthily IPO at the right valuation, a lot of the benefit goes back to public market investors, which are primarily retail over time. So I think it's a really good trend that we are seeing continues.
Well, Karthik, one of the concerns, though, and I don't want to generalize this because these are specific events and specific incidents involving specific companies and specific investors, but that has been the sort of dark cloud hanging over the Indian startup ecosystem through 2023 and 2024, and especially when you have what you would have thought were, the poster child, the poster boys of this space, face the kind of music that they are facing today and virtually in an existential crisis, it does put to question the governance metrics that people are operating with. How much of that is a concern today and how much of it is being acknowledged and being worked on in terms of course correction? Karthik.
I think it's a kind of, I would say those cases that you talk about are itself nuanced and layered. So outright bad behavior in terms of, punishable offenses, I think are a very small number, Shereen, right? The second is a little bit more rampant, I would say, which is, do they know how to manage their capital, their runway in a down market when capital is tight? Can they control costs? Can they turn profitable? I don't think that is as much as governance as exuberance that has to be curtailed. And if somebody didn't do it on time, companies have blown up as well. It's happened all through the history of venture. It's not unique. It's just that nobody had seen a correction and cycle in this particular bull market for like post-GFC in venture, right? And it peaked 14 years in as opposed to usual 7-8 year cycles. So I think it got a little out of hand. But when you look at even those collectively put together, there's not probably more than 20-30% of startups which are in trouble. Yes, you might say it's a large number, but you'll see that even in stock market downturns usually. So I don't think it's fair to not compare it with what would have happened in a public market downturn necessarily. That's one. The second, and that's why you have bankruptcies. They happen in the US, they happen here. Chapter 11 exists because of that. Now there's another 25, 30, 40%, including companies in each one of our portfolios in venture, where I think the founders have been smart that to acknowledge that they got lucky with a lot of money in 2021, 22, course corrected in time, will not maybe hold a candle to the valuations from 21, 22. And if you realized First Cry and some of these folks, they all listed at down rounds, right? So I think there's an acknowledgement that this is not a one-way street to go up. Markets will correct. And you have to correct your valuation and your inherent value expectations that you set with your investors to more realistic levels. And you can't wing the public markets, and private markets are absent at those levels any which way. So I think most of them who want to believe that they're building for 10 more years, 15 more years, and they're building sustainably, have done a great job of course correction, I would argue. And then, the last 30-40% are actually doing well. The numbers are like 2x, 3x from where they were 2-3 years ago. And they're riding. So I think it's a mixed bag, and you're absolutely right. You can't generalize. What you should be worried about is, have we finished the cleansing? And I thought it'll be done by 24 end, if you ask me. I think it's still a year and a half, right? I said that last year.
A year and a half.
But it's still going to take 12 to 18 months to fully cleanse. It's not done yet.
It's not done yet. Hemant, you agree that the cleansing is not done yet? And as Karthik pointed out, I mean, you've got some of your own portfolio companies that are going through difficult times at this point. On the resetting of expectations, on the recalibration of valuations and the cleansing that Karthik spoke of, where are we today and how much further do you believe we need to be in order for us to be able to get that reset?
Yeah, maybe let me add a few thoughts, because I generally broadly agree with Karthik as well. But when there is a glut of capital, it does affect behaviors. So we've seen that happen over the last couple of years, and we certainly are seeing correction in the market. What is true now, which wasn't true a couple of years ago, is that having a down or a flat round used to be a ding on your resume. That is no longer a ding on the resume. Which is making a lot of these conversations easier for the boards to happen, for new investors to look at a company and think about, well, why is this company raising a down round? It used to be a negative chatter in their heads. Now it's no longer that case. What this new wave or the post-Zorpira wave is bringing full center and attention is that a company's primary job to exist and reason to exist is to solve a problem that a consumer will pay money for. And for better or worse, when capital was freely available, that had become the primary job of the founder to go raise as much capital as easily as possible. And then that did lead to bad behavior, lead to defocusing of the business. It did lead to overspending in an inefficient manner in many ways. I think all that attention is now coming back to, well, what is the core reason for my business to exist? And in some cases, the business does not need to exist. We've had those companies shut down as well, where they were scaling and flying quite high during the pandemic, and post-pandemic behavior shifted back, and they don't need to exist anymore. So they had to return capital, and this was a collaborative discussion between us, the board members, and the founders. So we've seen all of this happen. It's hard to really call whether it's going to take another 18 months or not, but I certainly see the trend lines are positive, and we are seeing a lot of that cleanup already happening across the portfolio that we have, and also portfolio that we see as net new investors in other people's companies.
Well, it is the season for hope and optimism. So let me end by asking the two of you, and Karthik, I'll start with you. What gives you the most hope as we look at 2025, and where would you place your biggest bet on? Is there a sector? Is there a company? What do you feel most confident of in 2025?
Me, the theme all year, we have like an annual theme, and it's been about doubling down around our right to win globally as Indian startups, right? And historically, that was understood to be the domain of just software companies, and we actually think that's changing. We actually think we can win on hardware, we can win on hard tech, agri-robotics. We are co-investors with Hemant and Pixel. We're seeing the courage of founders who are now exposed to things that we never were at their age, to say that, why stop at Indian boundaries? So I feel like, in the future, 40, 50%, and that's when you ask me, what am I looking at? If we raise a new fund next year, it's going to be indexed a little higher on our ability to win in global markets, which means we're chasing global revenue pools. And I think it's, that the whole semiconductor question you asked about, if we have supply chains now to deliver the cheapest raw material for what is required to compete in the future, then we'll be even more equipped to go and win against the world. I won't fund semiconductor like chip, fab units, but everything that leaches off that, I want to be a party of, right? To build for the world. So that's my hope, that we actually have stellar outcomes across consumer health, consumer education, deep tech problems like space, agriculture, where we can service the world over the next decade and a half.
So right to win in global markets, that's the big theme that continues to dominate Karthik's playbook for 2025. Hemant, what about you?
Yeah, I think we are, as investors, we are at a very, very lucky point in time in the evolution of technology. Every 10 to 15 years, a new wave reaches an inflection point. And those who enter the world of investing and founding companies at the beginning of that wave, when they come out 10, 15 years later, a zero gets added to the outcome sizes, a zero gets added to the revenues that they are able to build, a zero gets added to the number of people that can be serviced through the technology. This happened in the 90s with internet, happened in the 2010s with mobile, and now it is happening with AI. And we believe that, people say, hey, what is your AI investment? We don't think of it like that. We think the question is as moot as asking, what is your internet investment? There is no such thing as AI. It will permeate and absorb every little thing that humans are going to do over the next 10 to 20 years, maybe even more. So what is exciting for us, there is a new technology wave that has reached an inflection point, but it is starting to look very hard to differentiate that from magic. And that will lead to new behaviors, new human population scale behaviors across consumer, across enterprise, across deep tech. Even hard to do things are going to be possible, where you could deploy AI to design new chemistries for us, new materials for us, and so on and so forth. So it's like a smorgasbord of interesting stuff that we can look at globally and invest behind. So it's a really space for us.
Well, Hemant and Karthik, many thanks for joining us on this Diwali special here on Young Turks to take us through the interesting intersections that you're going to be playing on and what you're watching out for in 2025. Always a pleasure. Wishing you, your families and your teams the very best from all of us here on the Young Turks team. And with that, it is time for us to wrap up this special edition of Young Turks. From all of us, here's wishing our viewers a very happy, safe and prosperous Diwali. Thanks for watching.